The federal tax code is almost 7,000 pages, and that's not to mention your own state's tax code. And buried in those pages are some non-obvious ways to save on taxes. My guest today works with individuals and business owners to find some of those non-obvious ways, and he's going to give us a few examples that maybe we can go take advantage of. I'm Carl White, principal at Mark Advisory Group, a healthcare marketing agency, and I'm also the host of Practice Care. The mission for both is the same, and that's to help private practice owners stay private. Usually that's what they want, but I believe that care is better when the providers own the practice, because there's clinical decisions. Obviously, there's also business decisions, and sometimes they sort of overlap or depend on each other. And it's just better, I think, when it's the clinician making those calls and not anybody else, because the point of the whole practice is to treat patients and do well while doing so. Better when the clinician's doing it. My guest today is Drew Powers. Drew is the founder of Powers Financial Group, a registered investment advisor. He specializes in advanced insurance and investment strategies for doctors, dentists, and any provider of care. Drew is 100% independent, which means he does not work for any investment or insurance company, which means he's able to give unbiased advice that is most beneficial for his clients. At Powers Financial Group, Drew leverages his stock and options trading expertise with his financial advising experience to help clients increase and protect their wealth. He lives in Naperville, Illinois, with his wife and their 2 kids. He's an avid downhill skier, so he sheds a small tear whenever it is not ski season. Drew, you are a returning guest, a 3-time guest. Thank you for coming back to Practice Care.
Thanks for having me. Is this like Saturday Night Live where you get a jacket after you've been on
Oh, they're
X
on
amount of
order.
times?
Yeah, the
They're on order?
5-time.
All right.
Yeah, we'll have a whole
Yeah.
preview when they go backstage. And yeah, we've called Steve Martin. We haven't heard back yet.
Yeah.
But we keep trying. Fortunes at the follow-up. So non-obvious ways to save on taxes. We're going to get into that. But first, for anybody who hasn't heard you on any of your other episodes, just fill in the gaps in your bio. Help us, to get to know you a bit better.
Yeah, sure. So I started my career on the trading floor here in Chicago, and I,
Mhm.
I kind of joke around and say that I feel like my time there, I saw it all and none of it works. And so,
Well, that's just the boost of confidence I need to go
yeah.
try it myself.
So I tend to focus more on where can we create tax savings
Mhm.
for high income earners, and we'll let the market do what the market does.
Mhm.
Twists and turns aside, it tends to go up more than it goes down,
Mhm.
and that's been the historical trajectory so far, so let's just keep riding that train.
Yep. There you go. And yeah, I forget who said it, but objectives number 1, 2, and 3 of investing is don't lose money. And I imagine save on taxes where you can would add right into that. And in the course of not losing, you'll win. So
Exactly.
yeah. So let's get into it. Non-obvious ways to save on taxes. I did a little bit of research. 7,000 pages of the federal tax code. Honestly, I thought I'd see a larger number.
Well, it is.
Is it?
The tax code might be 7,000 pages, but then there's all these rulings and decisions and
See?
opinions, which makes it like 87,000 pages
There it
that you
is.
really have to digest.
Yeah, not that 7,000 isn't large, but I was like, it's just because, a law
Right.
is added, but none ever seem to be subtracted or obsoleted or go, just strike that out. It doesn't apply. Yeah. So yes, I guess Congress would have to act on that. So it's very large. And then, I don't know what the Illinois state tax code is. We both live in Illinois.
Right.
It's more than a couple. And so your state probably has more than a couple wherever you're listening. So let's just get into it. What are,
Mhm.
some examples for individuals, some of the more non-obvious ways? And listeners, we get it. What might be non-obvious to us might be obvious to you and vice versa. We try to stay away from things like, well, the standard deduction on your income taxes, that seems like it's obvious and kind of automatic. So, Drew's been doing this for a long time. So we try to strike a balance of non-obvious without being like crazy, weird, esoteric, I guess.
Yeah. Right. Right.
Sorry for the tax jargon, but yeah. So let's get into it. What are some examples that you see that you like?
Sure. I wasn't going to bring up the standard deduction, but maybe we should real quickly. The standard deduction doubled during the Tax Cuts and Jobs Act.
2017. Yeah, true.
2017, right?
Hmm.
And so what that did is for some people who weren't able to itemize or so for some people who are just hitting the itemization
Hmm.
level on their personal returns, maybe
Hmm.
couldn't itemize anymore. So maybe a non-obvious way that we'll start with
Hmm.
is what I would say kind of stacking and bunching your charitable deductions all in one year
Mm.
so that you can take that nice doubled standard deduction for a year or two or three or whatever, and then make a big charitable, take 3 or 4 years all in one,
Mm.
make your charitable contributions, and then itemize that year.
So to go above the
It's
new larger standard deduction.
right,
Got
right.
it. Okay. Yeah.
Yeah. So
Okay.
one non-obvious way,
There you go.
um, which I didn't even think we would discuss.
Look at that. I
Who
know.
knows how applicable it is to our
Sure.
listeners? Higher
Yes.
income earners are usually, breaking that, but
Hmm.
regardless,
Yeah.
there are also some things that a lot of folks don't know about if you are an accredited investor. And the way this is measured is how much income do you have for the last couple of years,
Okay.
or what's your net worth?
Okay.
And I had to look this up. I think that these laws were set in 1983 and they haven't moved the goalposts
So
since.
they haven't been indexed for inflation or for anything.
No,
So what
no.
was a
So,
lot back then is not so much today.
right.
Got it.
So if you earn $200,000 as an individual,
Hmm.
300,000 as married filing joint, or have a net worth of $1 million.
And that's before deductions and whatever. Is that like your adjusted gross income?
Yeah, I
Okay.
I
Probably.
think probably
Probably.
or
Yeah.
modified adjusted.
Right.
It doesn't matter. It's such a low bar that all of our listeners are breaking
Right.
this.
Right. And
In
accredited just,
1983,
yeah, it was a lot of money.
that was like the
Oh,
equivalent of like 600 grand today,
yeah.
which would be a
Which is a
significant
lot of
bar.
money. And
Yeah,
when you say accredited, that's like your income or your net worth is a proxy for saying, well, you have a lot. You must know what you're doing more than
exactly.
the average bear.
Right.
Got it.
Right.
Okay. So
And
you're
not
smarter,
always the
air quotes.
truth.
Not
Yeah,
always the
right.
truth.
Yeah.
Not always the truth, but it's the proxy that is used. Okay, so
Yep.
keep going. If you are an accredited investor,
Right. There are investments that are open to you as an accredited investor that aren't open to others. And a lot of these have tax deductions or tax credits built into them. And I should back up a little bit. I'm not recommending these to anyone,
mhm,
right? This is just blanket statements. These are just for
yeah,
your general knowledge.
kind of like a
Um,
menu. We're sort of filling
yes,
out a bit of a menu here.
right,
Your
right.
choice,
So
listener. Yes.
yeah, some of the more well known are like gas and oil partnerships
Okay.
that have been around for 50, 60, 70 years
Hmm.
and had a tax deduction built into the tax code for all of this time. So they're not new,
Hmm.
but as those goalposts haven't moved and become more attainable, more people are aware of
Right.
it. So it may
Right.
seem new to you.
And
Um,
just because it's been around for a long time does not make it obvious. It could still be
right,
not obvious. Yes.
right, right.
Okay.
And so, whether you like gas or oil, not really the discussion here.
Yes, exactly.
Uh, you can have an electric vehicle and
Hmm.
it's 99% plastic and that's all a petroleum product, right? I mean, like plastic isn't
True.
going anywhere. So,
Petroleum is an input to
um,
plastic. That's right.
yeah, so it's still a commodity. It's still something that's being used widespread.
Hmm.
Is it risky? Does it have risk? Everything has risk.
Hmm.
Burying your money in a mason jar in the backyard has risk. There's no
Correct.
such thing as no risk. So,
Correct.
of course, there's risk, but there's also tax rewards
Hmm.
and there's some return rewards. There are solar energy credits for
Yeah.
investing in solar energy companies. There's a number of these types of things
Hmm.
that people may not be aware of, but are out there.
Hmm. Yeah. And so like, follow the tax code. Look at what's sort of the, federal government priorities, let's say over the past 5-ish years or maybe a little longer. What is it the government would like the country to do more of? So
Right,
up
right.
until 2025, it was solar. We'll see. We don't know. Um,
Sure.
yeah. What are some other examples?
So some other examples maybe on the personal side, if you have sold an investment asset, especially real estate,
Hmm.
We've all heard of, I'm sure that everybody listening has heard of 1031 exchanges.
Let's just pretend they don't. Not everybody.
If they haven't, it's a way for you to defer, minimize, maybe eliminate your taxes that are due on a real estate sale
Hmm.
by kind of rolling that money over into a new real estate investment.
Hmm.
And there's all different kinds of ways. I don't think we want to go too deep into the weeds
No.
today, but just being aware that these things are there.
Right. So if you
And
own a
all of
piece of
these,
real estate and you sell it, you're going to have to pay capital gains tax
mhm.
unless you, within like 30 or 60 days or something, you buy something with those proceeds that's similar, I guess,
Yeah,
right?
and there's a whole timeline and there's a
Yeah.
whole set of rules. These things are very precarious. All of
Yeah.
these programs,
Yeah.
you have to do it the right way. And the
Yeah.
1031 especially,
Yeah.
there's very specific rules. You have to use
Yeah.
an intermediary. You don't just take the check and decide to do something later. So,
Hmm.
yeah, very, very complex set of rules. You want to work with a professional on those.
Hmm. Okay. Um, what about on the business ownership side, like the practice ownership side?
Sure. So for a practice owner,
Hmm.
we can now open up that whole employer sponsored retirement plan
Hmm.
uh, arena, because you as the practice owner, you are now the employer. You get to make those decisions.
Hmm.
And there's this whole set of rules
Hmm.
called ERISA
Hmm.
that everybody has to follow. They're not new.
Hmm.
If you're a practice owner, you've heard of ERISA.
What does it stand for? Do you know what it stands for? I've heard it a
Oh,
thousand times.
it's Employee Retirement Income Security Act, something like that.
I'll go with that. Yeah.
All you need to know is what it's saying is that if you're the employer, you can't necessarily make plans that only benefit you. You have to benefit the employee as well.
Okay.
There's two schools of thought on this. You could design, let's just say you're an ordinary 401k profit sharing plan.
Hmm.
You could design that in such a way that it is used to, as the industry jargon would be, to attract and retain quality employees.
Hmm.
So we're going to give the employees a whole lot of benefit here
Hmm.
as a way to keep them, to attract them to working for us and keeping them under our employment.
Hmm.
We can also tweak those rules a little bit and say, okay, we're going to give the employee the minimum amount required.
Hmm.
And for the owner or management, or for those who are producing the income,
Hmm.
let's maximize the benefit that we get.
Hmm.
And those are two very different looking plans.
Sure. And how would you maximize, like, if it's simple to explain, how would you maximize, like, what would that, just so I can wrap my head around it. So employees get a benefit, but not as much as the owners. So like the owners could contribute more, get a higher match. Like what?
Yeah. So you can, there's very slight levels of discrimination that you can put into some of these plans. You can create classes of employees. So you can have
Sure.
owners, management, employees, and
Okay.
you can very it's very slight if you were in a gigantic corporation. If you were
Hmm.
working at Amazon with 1 million employees, this
Hmm.
may not work as well.
Hmm.
But in a smaller practice setting, what you can do
Hmm.
for certain classes is significant.
Okay.
And so you could be putting in, just for instance, 20, 30%. Well, let's call it 20. Put in 20% for the owners,
Hmm.
and maybe the employees get a 4% match and a 4% profit sharing.
But the owners get
So
20 in this
the owners
example.
get 20. And, this is again a very specific example. This may not be applicable to everyone, but
Hmm.
there was a surgical center with one surgeon and about 25 support staff.
Okay.
For that surgeon, we were able to get between 401k profit sharing and a defined benefit plan. We were able to get almost 350,000 away pre-tax for the doctor,
Hmm.
and the total amount he had to put in for all of those 25 employees was about 30 grand
Wow. And then they
all
contribute the rest.
together.
So the employee
Hmm.
contributes on their own behalf. The 30
Hmm.
grand is like a match distributed
Yeah,
amongst,
yeah.
yeah,
It
okay.
it was a match. It was a employer contribution to the plan.
Okay. And
So
if
we
you,
can really skew these things.
yeah, and if you can recall, even if it's approximate, what was the tax savings before and after for the surgeon, before doing
Well,
all
I mean,
this and then after?
he's in the highest tax bracket. So
Okay.
all of that, nearly 350 grand, I don't remember what the exact number was at the top federal bracket at the, state income tax. We're able to get this in before some of the self-employment tax. So I mean,
Mm,
this is a 50% tax savings. So if he put in 350, maybe he's saving 175 grand in taxes.
which he otherwise would have
Yeah.
paid. Yeah.
Yeah.
Nice. Okay. Um, let's keep going. Practice owners. And then I have a question going back to individuals, but let's keep going on practice owners.
Yeah, sure, sure. So one of the things that I do a lot of is I'm mixing insurance and investments inside
Mhm.
of retirement plans. And
Mm.
this could go also for the individual.
Yeah.
There
Okay. This is what
there
I'm going to
are
ask you about. So perfect. Let's go.
Oh,
Yeah.
sure, sure, sure.
Yeah.
Let's back up then to the individual.
Okay.
A lot of folks don't realize that life insurance, certain types of life insurance, I'm going to call it permanent life insurance or cash value life insurance. A lot of people think whole life when they
Hmm.
hear about this, but that's
Yeah.
whole life is one type of
Okay.
permanent or cash value life insurance. There's a bunch of different types of
Hmm.
this.
Hmm.
But the key is that there's that cash value component. There is this kind of side bucket of money.
Hmm.
I'm being very careful not to use the word investment, right? Because we're going to
Yeah.
stay in compliant here. We're talking about
Yeah.
insurance.
Yeah.
So there's this side bucket of money
And is that the
that
money? Is
is,
that the premiums that you're paying in?
so you're paying in premiums.
Yeah.
Some of that premium goes to the pure cost of insurance.
Okay.
What is the risk of you passing away and this insurance having to pay a death benefit?
Hmm.
And then the rest is going to go to cash value.
Okay.
And cash
Which is
value is this
which
little
is
side.
which is yours, right?
Right.
Okay.
Right, which is yours, but it's inside the policy.
Hmm.
So
Right.
the advantage of this is that it grows tax-free.
Hmm.
And as you change the investments inside that policy, or once they're inside of there, they call it a sub account. When you change
Okay.
whatever product is in there,
Hmm.
so hard to stay compliant on this when
Yeah.
you're talking about this.
I'll take your time. It's all right.
Yeah, it's not triggering a capital gains tax. There's no taxes inside of that policy, and then you can
Okay.
access that cash value tax free. So it can be a real wealth building tool.
Hmm.
But there's a change in thinking that has to happen. Most people, what they want to do is pay the smallest amount of premium and
Hmm.
get the biggest amount of death benefit.
Hmm.
That's how you
Because that's
typically,
how you're thinking about it. I mean,
right.
yeah, it's funny. Like I was either talking to you or somebody else a number of years ago, and I walked away from about this, and I walked away from the conversation going, it seems like the worst thing that ever happened to life insurance was being named life insurance.
Yeah.
You know, like
Right.
term life insurance, I get it. I mean, there's really kind of
Hmm.
only one purpose. You're renting insurance, and if you die, it pays out, and if you don't, it doesn't. You obviously hope you don't ever use it, but it doesn't
Right.
have any of the other features that what you're talking about because you don't own it. You're
Right.
renting it. That's what term.
Right.
Yeah.
And that's kind of the goal of most people is, you're young, you've got a new practice, you've got a young family, you're saying, well, I need $2 or $3 million of life insurance. What's the least amount I can pay for it? Well, that's
Sure.
where term insurance shines, right?
Yes. Yes.
This one, you just have to flip that thinking right on its head.
Hmm.
Now you want the smallest possible death benefit
Hmm.
and put in as much money as you can, as pay as much premium as you can,
Hmm.
because now you're paying for this little bit of insurance,
Hmm.
and the rest of that is going to cash value.
Hmm.
And there are testing that has to be done here.
Hmm.
The insurance company does it, but it's very clearly stated in the revenue code, how much you can put in and still retain the tax-free benefits of life insurance.
Okay.
And
And what are some
so
examples that you can use that sub account balance for?
anything. There are
Really?
some restrictions as to how quickly you can get it and how you get at it,
Hmm.
not for this show, but it doesn't matter
Yeah.
because you can take it out. So college,
Hmm.
I know people who buy their car and, you know, loan it from their policy and pay it back to the policy as if they were paying it to the bank. It's just a little mind game, increase their
Yeah.
own savings.
Because when you take money out of the sub account, do you owe it back or no?
Yeah, I mean, we're going to get too deep into the weeds.
Okay.
Technically, no.
Okay.
If the policy grows and there's enough in there to keep it going.
Okay.
But the trap here is that if that or when that loan causes when that subtraction of cash value causes the policy to lapse,
Hmm.
that's when you get a tax bill.
But
So
if
it
you're
still
and
has to be managed.
okay, but if we're hitting the weeds, tell me. But if you're making your premium payments every month, isn't that keeping the policy current no matter how much you take out of the sub account or no?
No.
Okay, stop
So
there.
yeah,
Stop there.
right.
Got it. Got it.
It still
Don't try
needs
this
to
at home,
be
folks. I
right.
got it.
It
Okay.
still needs to be managed. I think the idea that everybody should take away is if you're doing this for cash value accumulation, if you're using this as a wealth building tool, you need to
Hmm.
flip that thought on your head. And this is
Hmm.
not what's going to protect your heirs should you
Correct.
pass away. It's the death benefit is small and the amount of money you're putting into it is big.
Right.
And that way we're maximizing the growth of that cash value
Okay.
and still remaining in the limits of the tax code.
So I think this is the last question I'm going to ask about this. But let's
Sure.
say, okay, you've got a large cash value, it's years down the road, the policy's current, the death benefit is small, and then you pass away.
Mhm.
What happens to that cash value sub account? Does that get, do you sort of list who's supposed to get it as beneficiaries and that's where it goes?
There's kind of there's multiple ways to build a life insurance policy death benefit. Some of it will just pay the death benefit,
Hmm.
which of course would be something more than what's in the cash value.
Yeah.
Or you might have this small level of death benefit that and the cash value and it
Hmm.
tracks that.
Okay.
So in the end, you're still going to get, let's just say in the end, somebody's getting that money.
Yeah. So it kind of works, it looks and feels like it's not a death benefit, but if I had 1 million in the cash value and 200,000 in the death benefit, 1.2, and then I pass away and my wife is the beneficiary, would she get the 1.2?
Yeah, if you design it that way.
Okay.
Yeah.
Or it
Yeah.
could be a 1.2 million death benefit. I pass away, she gets it.
Yes.
So it's the same. It could be the same.
It could be the same. It's probably beyond our discussion here.
Yeah. Okay. All right. All right. So then that was about, so we talked about insurance and
Sure.
thinking about, I guess if we call it life insurance, the while you're living part of life insurance and what you can
Hmm.
do. How much of that translates to practice owners? You talk about insurance and so, we just talked about individuals. Maybe we talked about both. You tell me. I just don't want to lose the
Yeah,
thought.
so we have some of these same things. Like we can attach a cash value life insurance to a retirement plan or embed it inside the plan. And that's about as deep as that discussion should go today.
Okay.
And allow even more contributions and deductions
And if you
into
embed
that
it,
retirement plan.
and if you embed it in, are there more tax savings somehow?
Yeah, you're going to be able to contribute more and deduct more.
There it is. Okay.
Yep.
So there's
Yep.
we just checked the non-obvious box.
Right.
Okay.
Yep.
Um,
That's not without its own problems. You have to buy it out of the plan.
yeah.
There's a whole list of things. Like these things do get complicated.
Yeah. And you know what? Sometimes the complications and the cost, I mean, you might look at it and go, oh, I don't want to do that. Not worth it. For
Oh,
whatever, you know.
right, right,
Yeah.
right. This isn't the kind of thing where you say, oh, I'm looking to, put away an extra 5, 6 grand a year. Why don't I attach life insurance to my retirement plan?
Yeah.
No,
No.
we'll find other ways.
Okay. Yeah. This has to
Um,
be where there's just a very large um, taxable amount of income that you're like, this is
right.
large enough to start thinking about beyond the regular.
Hmm.
Like, you're not going to go to
Right.
you're not going to walk down aisle 5 of the grocery store and buy yourself any of these things.
Right. Right. But
Okay.
then we can mix that insurance and investments inside of retirement plans, right? As
Hmm.
we've discussed, charitable plans.
Hmm.
It's amazing how much money you can make for yourself when you give a little bit to charity.
Hmm.
And
What do you,
the
what do you mean?
well, so you can set up a trust or some kind of a fund where you're going to pledge X amount to charity, and then that can grow inside of there, and you have to give a little bit to charity every year, and then you get to take the balance.
Uh,
Or maybe you give you pledge a large amount to charity and you take a little bit every year, and then whatever's left over goes to charity. Like there's a lot of ways to build these
I
things.
gotcha. Okay.
You can still benefit and get a decent charitable deduction this year without
Mm,
losing control of all the money.
got
Uh,
it.
Putting life insurance inside of an estate plan. The federal estate exemption is huge,
Hmm.
right? 26, 27 million. Not
Hmm.
a lot of folks are going to break that, but 13, 15, 17 states have a state estate tax,
I
Illinois
think,
being one of
yeah, I
those.
was going to ask. It's a lot lower than
I
that.
I think the cap is 4 or 5 million. I'm not exactly sure where it is for this year.
Hmm.
A lot of our listeners are going to hit that number. And
Hmm.
so if you know you're going to have a tax bill due, putting some
Hmm.
insurance inside of your estate plan,
Hmm.
paying pennies on the dollar in terms of paying the premium.
Hmm.
And when you pass away, here's a big insurance policy that pays those taxes. You just got to pay your taxes that you
Oh,
were going
there
to
it
pay
is.
anyway,
Okay.
and leverage the amount.
Yeah. Okay. Interesting. Um, what are some, we'll call, since we're calling them non-obvious ways, what are some
Mhm.
non-obvious ways to watch out for? Maybe it's the conditions. Like, what do you, hey,
Yeah,
this, nobody's here's thinking, oh my God, this is amazing. I'm going to go crazy. Okay, hang on. How do we know what to
right.
watch out for?
Right. I'll speak in real general terms.
Hmm.
The crazier it sounds, probably less well it works.
Mm,
There were like a number of NFL football, NFL players, football
yeah.
players,
Yeah.
who got roped into some horse racing, um,
Thing.
racehorse training and breeding scam, and it didn't work out.
Hmm.
Uh, you know, there's one thing that I've seen a number of times is um, people talk about, well, let's borrow against your accounts receivable in your practice. And if there's some arbitrage there to be made, and that
Yeah.
can work. I was sitting with a tax attorney once, and he was explaining how you really have to do it. And it was so complex and so many moving parts. And he
Yeah.
was like, if you do it the way it's being sold to these doctors and dentists, it's going to blow up. You have
Hmm.
to do this super complex way, and then it's legal. And it's, well, how much accounts receivable do you have, and how much arbitrage can you really scrape off the top of that? And is it worth all of this complexity?
Right.
So
Right.
things like that. And then also understanding that tax law, the joke is tax law is written in pencil.
That's it,
Yeah, it's
really?
the law today,
Yeah.
but tax laws change.
Hmm.
Sometimes you're grandfathered in and you're allowed to work under the old regime.
Yeah.
Sometimes they say, nope, this is how it's going to be going forward and it's all going to change.
Yeah.
So if you're getting into something where you can't afford to get out of it,
Mm.
that's going to be a problem. If
Hmm.
something changes and suddenly you have to come up with a bunch of liquid funds to get out of this thing, buy your way out of this plan
Hmm.
and unwind it,
Yeah.
now you're stuck with whatever our regulators in their infinite wisdom have decided is going to be the rule of the day.
Right. Right. So there's a couple things in there. The first one you said was if it sounds crazy, and listener, that means to you, right? If something sounds
Right.
crazy to you, but your neighbor'd say, oh, that's the simplest thing in the world, well, then you probably should not do it, and your neighbor might do it, right? There's no
Mhm.
intrinsically that's easier, that's difficult. And the other one, I really liked it. It's, what I took away from what you said is what if you have to unwind it and get out? You need to ask whoever you're working with, what if it flips back? How, if
Right.
I had to get out of this quickly, how would that work? Do I have to come up with a
Mhm.
bunch of money? You just how does what does that look like? And you need an answer that makes sense to you.
Right.
You just
Right.
do. And so if the answer doesn't make sense, I'd say, I mean, the thing with the racehorse thing, we were talking about this the other day. Unlike, I mean, what I heard was, so I need a small group of horses to perform well. It's kind of what I said is, and if you've been to the horse races even once or watched it, sometimes the favorite doesn't win. And what
Right.
the hell? That's that. So I need a horse to perform reliably or whatever it was. And my risk is
Yeah.
concentrated into a couple of horses that I really can't reason with.
Right.
Why
Right.
would I do that?
And
I don't even know anything
right.
about what these players got into, but it
Well, and in
just,
this case, it was really a way like buying a horse is expensive, training it is expensive before you ever get to race. So it's just this way, like, here, we're going to create all these losses for you, and
Hmm.
you never have to show up or do anything.
Yeah.
And, there's very specific rules in the tax code about what's a hobby and
Mm.
what's a business,
Hmm.
and what's active involvement and what's
Hmm.
passive. And
Right.
so when you start to blur those lines, that's when
Right.
trouble comes.
Right. 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 Who do you recommend that listeners kind of, I call it like the team they should assemble to help them? If we're catching attention, I mean, since you're an accredited investor, so says the IRS, listener
Mhm.
X, doesn't still mean you should go out and try this, on your own. Who should be in the room trying to help them figure out, and what kind of qualities would you, want to see them have?
Yeah, so I think you need a whole team here.
Hmm.
So if you meet with your financial advisor and all you ever do is talk about your portfolio and the returns and a bunch of jargon like BIPs and Sharpe ratios and alpha and beta,
Yeah,
you don't really have an advisor. You have a money manager,
fair
or you
enough.
have
Yeah.
a asset gatherer, somebody who just grabs a bunch of clients and stuffs them into a portfolio.
Hmm.
You want somebody who's going beyond all of that
Hmm.
and talking about places where you can save real money. And I think that's in the tax code.
Mm.
So you want to be working with advisors who are talking about these things and making this part of the conversation,
Hmm.
and then not acting alone.
Hmm.
We should have a CPA who is familiar with these things. If you go to your CPA and they say, "Ah, yeah, I've heard about that. I don't really recommend it,"
Yeah.
that's not really an answer.
Yeah.
You
I
know,
think of, well, why?
right, right,
Why?
right.
Yeah.
Yeah, you need a CPA who's familiar with these things. I think you should have a tax attorney.
Hmm.
I think you should have
Hmm.
a state planning attorney. Sometimes those two can be the same person. A lot of times they're two different attorneys.
Hmm.
And put together a whole team. And then you have to have providers who have access to these things, who are reputable. Like on your show earlier last year,
Hmm.
you had somebody who was talking about captives. That's one thing for the business owner I didn't mention.
Yeah. Yeah.
It can work great if you have the right provider
Yeah.
and somebody guiding you,
Yeah.
but it's also, if you put the wrong thing inside that captive insurance,
Yeah.
it blows up the whole plan.
Yeah. His name is Van Carlson. You
Yeah,
look up Van Carlson Practice Care. I was mesmerized. This
yeah,
sounds so cool, but
right,
it's an example of you need the experience. Like there's just it's a minefield, and he knows where
exactly.
the mines are because he's been doing it
Right.
long enough. You know where the mines. So yeah.
Well, so as an advisor, what I would be doing is I would be saying, "Hey, let's go talk to Van. I think you're in the right place for a captive.
Yeah.
Let's do that." But captives are on the IRS Dirty Dozen list every year
Oh yeah.
because people put the wrong things in it.
Because they screwed
So
up.
let's
Yeah.
talk to a professional.
Hmm.
Let's make sure that the CPA, the tax attorney, and the estate planning attorney, we're all on the same page.
Yeah. And just to
And
tie a couple of points together,
mhm,
I asked you earlier, if you're going to think about some of these things, the tax savings should be, I'll say, significant without assigning a number to it. This team that we're talking about, which I totally agree with, there's some cost to that team,
of
right?
course.
There's their time. So, if you're going to spend, I don't know, 20 grand on the team to get it ready once or whatever, the tax savings either you don't want to break even. I'll say I'll spend 20 to make 20. Well, no, that's stupid. And it's all your time to, so like, this is why 5, 6,000 bucks or whatever, a modest amount, um, keep it simple. But
Yeah,
every one of these people should be able to
right.
explain to you. I face this in marketing, right? And I say about doctors, plenty of doctors and dentists and such don't know much about marketing, but they can smell when something sounds illogical or they're
Right.
just not following it. Everybody knows what jargon sounds like, even if they don't know what the jargon word means. You're the same, right? It's got to make sense to you. And if it
Right.
doesn't, then you could still do it, but it's more hope than strategy. And, hope is not a strategy. So,
Yeah, exactly.
and it's not easy. It's not easy in the investment or in the financial world to find people who can actually explain something clearly. Like the first time I ever heard insurance, and you were far from the first person to try to explain it to me, I walked away from you going, I finally get it. Like I think I finally get it. Like, holy cow. I didn't, I wasn't even looking for that because I was beaten down by unexplained, understandable answers. But every one of this team's got to be you know,
Hmm.
yes, I understand it. So yeah,
Right. And I
yeah.
think folks should just reach out to you. Look at all the great providers you've had on the show.
Yeah, just go through the
You know?
library. We've had Van Carlson, we've had
Right.
Drew, we've had some accountants talking about the Augusta rule, didn't even get into that one. They
Sure.
actually explain it in a way that makes sense.
Right. Right. Another
Yeah.
one that gets abused left and
Oh my
right.
God.
And it can
Yeah.
work so beautifully when you just do it right.
And like at least what they said. So the Augusta rule, folks, Stefan Goldsmith and Kristen Engeron, those are the two guests. Um, the number one way you screw up the Augusta rule is by claiming too much.
Hmm.
Is by just overshooting on the fair market value of what you're doing. So there's your
Right.
teaser if you want to listen to the episode, but don't get greedy. That's pretty much universal, right? Just you want to do these rule number one, don't get greedy.
Right.
Rule
Right.
number two, what
There's
makes
a
sense?
there's a great tax attorney in Los Angeles who says, if it sounds just amazing, it's not going to work. Like so much of what we're doing is we're deferring it for a later time,
Mhm,
knowing that we have to unwind it again some other way.
mhm,
And so we'll do a lot of these strategies multiple times to sort of unwind
mhm,
all of the built up, tax liability that's coming.
mhm. Yeah, so you're kicking it down the road. Exactly. Um, Man, we covered a lot, but in the context of that,
Sure.
is there anything you think we should have touched on that we didn't?
No, I think I would just for our practitioners who are in that top tax bracket,
Hmm.
right? And that's a lot of them,
Hmm.
maybe most of them.
Yeah.
It's not necessary for you to be paying all these taxes if you have the ability to save some of that money.
Hmm.
We can keep it in your pocket
Hmm.
and out of Uncle Sam's,
Hmm.
and we can do it in a very conservative, compliant way,
Hmm.
as long as we don't get, over our skis, so to
Right.
speak.
Right. Okay. Um, and where should a listener get started? What would you like,
Yeah,
so we've
any
caught
one
their
of
attention, like, I'm in that bracket. I feel like I pay a lot of taxes. Um, what's a where would you recommend they start?
yeah, any one of your listeners want to contact me,
Hmm.
we can talk about a whole lot more when it's a one-on-one conversation and we
Right.
can have like the specific facts of your case.
Hmm.
And then we can start digging into some of these things
Okay.
a little bit more exact. I would be happy to talk to your financial advisor, talk to your accountant,
Hmm.
any number of professionals that you have around you. Call the folks that have been on your show.
Hmm.
There's a lot of providers who can help you get started with this.
Yeah.
And I'll just repeat, I'm happy to have that
Yeah.
email or that phone call or whatever
Sure.
somebody would want.
Sure. I would think also, take a look at, so we're recording this on April 10th. So tax day is nigh. It's right around the corner. I don't know, end of April, whatever, unless you defer. Well, you still make a payment if you have to extend. Take a look at the amount of taxes that you're paying over the full year, not just a check
Right.
you wrote in April, and just stare at it and go, wonder if that could be smaller.
Yeah.
And
I
just,
I
you know,
I joke and I say, it's not totally a joke. I say, if you're not completely giggling, if you're not giddy about how little you pay in taxes,
mhm. There you
and you
go.
have the ability to save some money, you're not spending every last penny that you earn,
Hmm.
give me a call. I bet you there's a lot more that you could be doing as that practice owner
Yeah.
and get yourself into that
Yeah.
giggling state every April
Right, because
15th.
the check that you pay in April, assuming you pay one, is not the total amount of tax that you've paid for the year. It's just the amount that you haven't paid yet. It's April 15th. People say we do our taxes. You're really just kind of truing up the taxes. Um,
Yeah.
and there's I don't know which line it is, but on the first couple pages, there's a line that says this is the grand total amount of taxes you have paid. And it also shows you what you think you've earned, and you can sort of compare them. And just stare at it and go, man, I wonder if that could be smaller in a
Hmm.
way that doesn't blow my brain apart of complexity. And just, talk to your accountant. Say, "God, could this be smaller?
Right. Right.
Could this be
And
smaller?" Maybe there's some simple ways, right? Maybe you don't have a retirement plan at all.
well,
Maybe, I don't know, not that your accountant screwed up, but maybe there's some, what if that could be in half? What if that could be smaller? Is there a way to do that? You know?
yeah, accountants have a tax preparer has an incredibly difficult job because these forms aren't created till the end of January.
It's true.
And then they have to be in corporate March 15th and personal April 15th.
Hmm.
That's a really small amount of time to reconcile an entire year.
Hmm.
I know we're getting a little bit long in the recording, so maybe this is a topic for another time, but especially for our practice owners, you're not done on December 31st, right? There's still
Yeah.
things you can do on the personal side up to April 15th, like in
Hmm.
terms of your IRAs.
Hmm.
There's things you can do up to September 15th, your corporate extension date
Hmm.
for the year prior. So you've got 9
So
months.
there's some time to sort of, I'll say,
Right.
clean it up,
Yeah.
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 There's still time to fix last year,
Hmm.
but that time goes quick.
Yeah, it does. It does. We're
Yeah.
also busy and exactly. But yeah, stare at that number, go, I wonder if that could be smaller. And sometimes it's smaller, but not enough to bother. That's a silly thing
Right.
to say, but
Yep.
and sometimes it's like, well, you know what? That could be, yeah. Maybe
Mhm.
that's a good way in. Drew, thank you for coming back. Always
Thanks for having
interesting.
me.
Yeah, absolutely. Not that I'm I've got the universe at my fingertips, but I do mean it when I say you're the first person to ever explain cash value life insurance in a way that I actually grasped what the hell it means.
Yeah. I
And so,
appreciate that. Yeah.
yeah. So, all right. So, you gave contact information to us. We're going to get that into the show notes for your episode. If it caught anybody's attention, they want to contact you. Now they've got another way to do it. Couple of other points before we wrap up. First, you got to subscribe to Practice Care if you haven't done it already. Practice Care is one word. New episode every week. We're on Apple, Spotify, YouTube, you name it, easy to find. But the easiest way to stay up with new episodes is to subscribe. And finally, also, if you're like Drew or I and you want to help private practice owners stay private, grow their wealth, grow their practice, or if you're a private practice owner yourself and you've got some experience on the business side of private practice, either way, we want you to come on Practice Care and share your knowledge with the world. In the show notes for Drew's episode and every episode, there's a link. Tell us what's on your mind. It's super quick. We'll get you scheduled as soon as we can. Thanks very much, and until next time.